In our top business story, the IMF has slashed its forecast for growth in Saudi Arabia as it blamed the slowing Chinese economy, the collapse in oil prices and a slowdown in emerging markets for a cut to the overall economic outlook for the world. The fund expects Saudi Arabia's economy will grow at just 1.2% in 2016 and 1.9% the year after. Both figures are 1 percentage point below the IMF's October forecasts for the growth in the kingdom. Saudi Arabia announced an austerity budget in December that should result in spending falling by 13% this year, as government spending accounts for about a third of GDP and corporate profitability in Saudi Arabia remains highly dependent on government spending. Financial analysts also noted that progress on diversifying the economy from dependence on the government has been poor, which heightens the kingdom's vulnerability to collapse in oil prices. The IMF has also cut its outlook for global growth. The world's economy will grow by 3.4% this year, 0.2 percentage points below October's projection of 3.6%. The world is considered to be in recession when growth dips below 3% per year. It is expected to pick up to 3.6% next year. China has also announced that it grew at its slowest pace since 1990 in 2015, in a further blow to the global growth outlook. The country said that it grew at 6.9% last year. Dubai Electricity and Water Authority has announced plans to finalise the agreement for increasing the capacity of Hassyan Clean Coal Power Plant by an additional 1,200 megawatts during the ongoing Abu Dhabi Sustainability Week. The plans were revealed by His Excellency Saeed Mohammed Al Tayyer, the Managing Director and CEO of DEWA, during the World Future Energy Summit. The announcement comes months after the authority had selected the bidder for the first phase of the $1.8 billion plant to build two units of 600 megawatts each, which are expected to be operational by the year 2021. As part of their long-term plans, DEWA is planning to bring the total capacity of the plant up to 3,600 megawatts. According to Al Tayyer, the project will be built on the independent power producer model to leverage public-private partnerships and build new capacity in renewable energy and diversify the Emirates' energy mix in the long term.
This is the very efficient plant, 50%. It will come in service 2020. 1,200 we awarded recently. We are now under discussion. We hope we will finalize this week another 1,200. The private sector here, if we allocate total cost or total connected power, it's about more than 2,600 presently done by the private sector.
Commenting on the future projects and the high level of international interest in the 800 megawatt phase 3 of the Mohammed bin Rashid Al Maktoum Solar Park, Al Tayyer added that the Emirate is on track to increase the share of renewable energy targets to 7% by 2020 and 25% by 2030.
We have about 13 megawatt connected to the grid. And also we have another project, it's about 200 megawatt, which is under construction. We're going to commission this project by April 2017. 800 megawatt, we floated this tender 1 month ago. And it will be awarded by the second quarter of this year. So we will have 1,016 megawatt by 2020, and this is our target.
Deloitte has published its second annual real estate predictions report for Dubai, which provides an economic overview and review of Dubai's real estate markets in 2015, while also examining the latest trends and developments for the year ahead. The report revealed that despite headwinds, Dubai's real estate market offers some potentially good prospects in 2016. Looking at Dubai's residential market performance for the year ahead, published pipeline forecasts estimate that some 40,000 units will get delivered in 2016. However, according to Deloitte, consultations with key developers suggest a more realistic number will be approximately 10,000 units. 2015 saw average residential sales prices across Dubai decline by approximately 10%. And in 2016, it is predicted that average residential prices will decrease further, reflecting a transition to a more mature market. Meanwhile, occupancy levels at around 70 to 75% are likely to represent the new norm in Dubai's hospitality market this year, compared to 77.5% in 2015. And as operators compete for occupancy, it is expected that average daily rates will soften further, which should encourage growth in visitor volumes required to support the investment in tourism infrastructure. Service apartments are likely to be an area of focus in 2016, driven by growing visitor demand for longer average length stays and better value accommodation. The report also revealed that retail rental growth will be relatively flat in 2016, with the exception of super prime malls, and some secondary malls will need to incentivise the major retail groups to retain brands. DMCC, the Government and Free Zone Authority for Trade, Enterprise and Commodities in Dubai, and DIFC's Dispute Resolution Authority have signed a memorandum of understanding to further enhance bilateral trade relations. The terms of the memorandum state that the two entities will collaborate to provide DMCC member companies with access to the DRA services, including DIFC courts, which are recognised as one of the world's leading commercial court systems. The agreement also provides a launchpad for initiatives that will enable the DRI to support DMCC members and DMCC's exchange and commodity trade platforms in respect to the enforcement of commodity and other commercial transactions. According to officials from DMCC, the terms of the memorandum, which strengthen ties between two of Dubai's leading free zones, cover a range of areas of mutual benefit to DMCC and the DIFC's Dispute Resolution Authority, including access to professional services, trade and financial infrastructure, and collaboration on events and knowledge-sharing initiatives. The DIFC's DRA was established in 2014 as a platform for delivering legal excellence in the Middle East and as the gateway to a suite of services available to businesses operating in Dubai.